So subsequent events or off the balance sheet events, it's a very small topic, but currently highly examinable. Previously, they didn't use to test this. Yes, it's just like the evidence one we've done, they don't test, but one day they will. There's a time in excess of 10 years they were not testing this, but when they started, now they tested so often, so often, so often. So subsequent events, we say that these are events arising. These are events arising after the balance sheet date, after the balance sheet. It's i.e. end of the financial period. End of the financial period. They are arising after the end of the financial period. That we are here, starting from 1st January 2023 rather, up to that 1st December 2023, and issues are still arising which affect these books of accounts. And we've already come to the end of the financial period. That's why we are calling them off the balance sheet events. Off the balance sheet events. They are subsequent events. They could be favorable. They could be favorable or unfavorable. Although this is not the major classification, that's just mentioning. They could be favorable or unfavorable. Favorable in what sense? You could be having a data that you've written off within this year. Then today being 18 or thereabout, they show up and pay. That's a favorable of the balance sheet event. Other events could be that after the end of the year, somewhere in February, March, a major debtor passes on. A major debtor is adjudged bankrupt. Or we proceed to lose a court case. A court case which commenced somewhere in April last year is determined after we are through the financial period and we lose the case. We are required to compensate the aggrieved person. That's an unfavorable situation. So they could either be favorable or unfavorable, but again, that's not the major classification of these events. We can say transferred into two. They are transferred into two. Roman number one, adjusting events. Adjusting events. And Roman number two, non-adjusting. Non-adjusting events. We have adjusting events and we have non-adjusting events. Now we start with Roman number one, adjusting events. So adjusting events, what we know about them is they happened here. They happened during the financial period, or they have their roots during the financial period, only that they are confirmed after the end of the financial period. Yes, so we can indicate maybe for proper understanding. They arise during the financial period. Arise during the financial period, but only to be confirmed after the balance dates, after the balance sheet dates. And we say they should be adjusted. They should be adjusted in the financial statements. They should be adjusted in the financial statements. What you're saying, they are arising here, but we have to adjust these records. Otherwise, these financial statements without the adjustments will not be considered to be portraying true and fair view. We have to adjust. E.g., let me give you examples. For instance, A, headed by Isa 240, errors and frauds. Yeah. For instance, you are auditing the 2023 books of accounts. You're in February, you detect some errors. Unless they are corrected, the 2023 books of accounts do not portray a true and fair view. Number two, guided by IAS number 2, stock valuation. Stock valuation. You know, we said we don't have a stock account. You should remember that. We don't have a stock account at all, because valuation of stock is not derived by way of double entry. We do physical verification, either through an integrated system or physically counting stock. And IAS number 2 requires that we record stock at the lower of cost and the net realizable value. So we may record our closing stock here at 8,000, only to realize 6,400. It means that this stock was overstated. This was our closing stock, but by February 15th, we have sold all the stock and we've only realized 6,400, meaning that we've gone against IAS number 2, recording closing stock at the lower of cost and the net realizable value. We need to adjust these records, otherwise they are materially misstated. They are materially misstated. C, guided by ISA number 540 or IAS number 37, contingents. Contingents like court cases or stroke litigations. What happens is, let's say we have been taken to court here, 1st of January 23. Up to the end of the year, the case is yet to be determined. Cut-off assertion, that expense should be recognized here, because this is when it happened. This is when it happened. If we are not sure about the true costs that we are likely to incur, or even you're not sure about the remedial compensation fee, the much you are likely to compensate the aggrieved person if you lost the case, then you're supposed to create provisions. And that's why we say entities creating provisions for audit fees, provisions for directors' emoluments, provisions for debenture interest. They create some provisions until it's confirmed. So here in the B sheet and in the income statement, we expect to find provisions for legal fees, because this case commenced here. Now, create provision at 8,000 again. Case is determined somewhere in 20th February. You can confirm you've incurred under 6,400. It means that the provisions were overstated. Other times they were understated. We need to adjust. We refer to them as contingents because they're only confirmed upon occurrence or non-occurrence of certain future events. Occurrence. So the common feature of these 3 items is they happened here. The errors were committed here, only to be confirmed after the end of the B sheet. The stocks belongs to this financial period, only to be confirmed about their true value after the end of the year. The cases commenced here, only to be confirmed after the end of the financial period on how much we are incurring. And again, D, budgets. Budgets written off, or basically irrecoverable debts. Irrecoverable debts. Hata kuna swali kwa mtihani yetu, is it June 2013 or December 2013? Yeah, it's a case on ISA 700 auditor's report, and we are told we closed the year as at that December, but somewhere in February, actually it is in February, a debtor is declared bankrupt. That's a bad debt which existed here. It existed because we had already sold to them on credit here. but we are now confirming that the debt is recoverable after the end of the financial period. Prudence concept. What does prudence concept require us to do? Tuko na prudence concept, tuko na IAS number 18, revenue recognition. Right now it is IFRS number 15 on revenue recognition. We recognize revenue when it has been earned. We recognize losses when we anticipate. When we foresee a loss, you capture it. That's what we do, even in IAS number 11. IAS number 11 is on contract accounts. When you're using percentage of completion method or contract completion method, in both of them, you foresee errors, you record the whole of it in that financial period, you've foreseen it. So this is that debt which is being confirmed after the end of the year. It was here only that we could not see it, we could not confirm it. So all this, or basically these four components are adjusting. If the last year's financial statements are to be said to be portraying to a fair view, then we have to adjust these four components. Any questions? Of course, these are bad debts written off after the B-sheet date. Yes, please. Yeah. Yes.
If you could see a lot, you could experience someone when other ways to the
yeah, I guess you are talking about the ways we can mitigate, like hedging and other ways of preventing or mitigating these losses. But of course, you try everything possible. You try everything possible as an entity to mitigate these, or even to recover the loss. But let's give an example of contract IS number 11. Why is the loss arising? Because the prices of raw materials have escalated upwards. You see, you're foreseeing a loss. Because you see, what you had factored in has changed. And the contract may not be having an escalation clause. It's all fixed. We've seen contracts being executed at a loss. Other times, they are not even able to execute because the monies dispersed to take care of it are not sufficient. That's already a loss. Without an escalation clause. You have some contracts with escalation clause. Allows you. Escalation clause me? No. Escalation clause me, it is a clause indicating that we can flex our budget, like the way government does when it falls short of funds. So they always go for supplementary budgets. They don't stop at that now it will not be possible to execute a certain thing because funds are not enough. They bring supplementary budgets. Its escalation clause works in the same manner in contracts that have entered into contract with you to construct a building. You paid me half of the amounts is upfront. Along the way, you've made other disbursements. But along the way, we realize the money is not enough. Someone may say, we entered in our contract. I gave you the funds to do a complete job. Failure to complete it, that's breach. I may seek legal redress. Our contract may have an escalation clause allowing us to adjust the figures if prices in the market changes, which means that if the contract price is not enough, we add some more money. There is flexibility. Escalation clause gives our contract some element of flexibility that we can adjust our figures. If you are paying me $500,000, you could do 530,000. You add some more money to take care of additional costs that have come in. But without an escalation clause, I may still continue to execute the project, but I may run into losses. Call it escalation clause. It will bring some flexibility in the contract. What I was saying? When you foresee a loss, you recognize it immediately. It's like the expenses. When do you recognize an expense? When you incur, right? You incur even if you have not paid. You recognize it. like rent. That's where we apply the accrual concept. Because we are operating in rental premises and rent is in arrears, we will still record rent expense in the income statement and in the B sheet as liabilities because we are operating on rental premises. That has already occurred. So if you foresee errors again, that in this transaction, we are pretty sure around the way we run into losses, and we may not be able to mitigate it because of the nature of the engagement. You can't wait until you get there to recognize it then. You create a provision for that loss now. That's what you do in contract accounts. You foresee a loss, you recognize it immediately. I'll get your reasoning that, oh, why would we not mitigate it then? We are foreseeing a loss. Do we still sit down and wait for it to happen? Not at all. We'll do everything possible to mitigate it. But you've seen it, you've foreseen it, you're supposed to recognize it immediately. Do everything possible about it. But you foresee errors, it should be recognized in the books of accounts. Why? Prudence concept. Prudence concept. And the IAS 18 and IFRS number 15. Recognize it the moment you foresee it. Without recording it, you'll be overstating profits. Yeah, death of a major customer, I'm being told there, creditor, not customer. You know, now customer, let me see, because there are things that will affect the other parties' books of accounts. Like here, if a debtor dies, that's why we are writing off. What if a creditor dies? What does it mean to us? Is a person thinking from that other side? What if a creditor dies? A creditor dies. Unajua high school tukihandwa tukiwa mono tulikuwa tunaambiwa tufanye mdomo vile mtu anafanya. Tunaambiwa fanya hivi. Unajua sasa hiyo unagongwa. Lazima unafanya fanya hivi, fanya hivi, fanya hivi. Sasa shida ilikuwa inakuja kufanya hivi. Because now you can't raise here. Yes, ndio naona huyu anauliza creditor ni hii side nyingine yenye. And it's a good question. It's a good question. That's not affecting us in any way. If it's affecting us, then positively. If you're not repaying, it's positive. That's Shiro. What about?
The debt was written off.
It was written off?
Yeah, like the previous year.
Mhm.
And then it's paid when we are closing now is current year.
The funny thing about them, we recognize the budgets recovered in the year that you have received them. We don't go back to when it was written off. Let's say you wrote off a debt in the year 2021, and a debtor is showing up now to make it good. You just recognize it now as an income. The moment you record gross profit, discount received, you do budgets recovered. Budgets are recovered. In this year's books of accounts, you don't go back to the previous. Don't go back to the previous. Perfect. Although when there is only, if you're calling it an off the balance sheet event, it would qualify. Because even these ones, there are times they may come up after so long. Where do you adjust them? We adjust them in the statement of changes in equity. Have you ever seen right after opening balance, you do prior period adjustments? Yes, you do prior period adjustments. So I believe you can add it here as an example. You can add it here as an example. Yes, we post them in the statement of changes in equity. Right after opening balance, we do prior period. We do prior period adjustments. Yeah, they are very interesting. Good. Loma number 2, non-adjusting. Non-adjusting events. They have nothing to do with last year. They happened purely after the end of the year. That's when they are happening. They have nothing to do with last year. Yes, so we say arises after the end of the year, but they need not to be adjusted. They need not to be adjusted since they have nothing to do with last year. They have nothing to do with last year. They can only be recorded. They can only be recorded in the notes to the financial statements. They can only be recorded in the notes to the financial statements in case they are pervasive. Pervasive and significant. Pervasive means they could affect the decision making of intended users. So don't reflect them in the books, but capture them in the notes if they are pervasive. Pervasiveness meaning that they would affect the decision making of intended users. For instance, we could be having issues of from A, mergers and acquisition or business combination. Business combination. We are talking of mergers and acquisition. Mergers and acquisition after B sheet date. After B sheet date. You see, this one does not have anything to do with last year. We crossed so well here when we adjust ABC. XYZ is coming after the end of the year. So we need not to reflect. We need not to reflect in the previous year's financial statements. B, closure of some business operations. Again, after B sheet date. After B sheet date. Maybe we were doing accounts, we are doing CCP, we were doing CIFA. Now we cross the CCP thing after the B sheet date. It has got nothing to do with last year. Has got nothing to do with last year. Again, we talk of disposal of assets. Disposal of assets relating to discontinued operations. Now that we have closed some business operations, we are disposing of assets relating to those operations. These are not the balance sheet event, but again has got nothing to do with last year. Has got nothing to do with last year. D, major asset valuation. Major asset valuation after B sheet date. We crossed the year when a piece of land we own somewhere was at 2.7 million. Then a road is commissioned there and the value shoots to 7 million. It is correct, we crossed at 2.7. It has got nothing to do with last year. So we only revalue now for this year. We only revalue for this year. E, destruction. Destruction of property, e.g. by fire. By fire up to the B sheet date. We can't adjust the previous. We crossed with all these assets. They've just been destroyed after the end of the year. They've just been destroyed after the end of the year. Number F, major. We can talk of major ordinary share issue, e.g. rights issue, e.g. rights and bonus issue, rights and bonus issue after the BC date. Rights issue, bonus issue, you're going to need a script issue. I believe so. Bonus is script issue after the BC date. After we have closed the year, we are saying that we are giving some shares on pro rata basis, either as bonus or as rights. That has got nothing to do with last year. It's purely a non-adjusting event. It's purely a non-adjusting event. Perfect. That's it on the other part of it. We look at accounting treatment. Want to rub here. So if somebody is screenshot now before I rub. But I'll avail the notes. Or you call them audit procedures. Just call them audit procedures. Transferred into 3. It depends with when this event have arose. So we have audit procedures with regard to events after the BC date, but before the reporting date. Number 2, events after the reporting date, but before books are issued to the public. Number 3, events after publication but before the AGM. For the AGM. So events arise like this, but this is the BC date like I had illustrated. This is 1st January 2022. We are talking of 2023 for this case. Up to that 1st December 23. This is the BC date. BC date. Some events will arise after the BC date, but before the reporting date. After the reporting date, but before the books or accounts are available to the public. After the reporting date, but before the AGM, and so on. So what you're supposed to know, after the reporting date, or in these both cases, this is a different case and this is a different case, and all of them now combined. Auditors do not have any obligation. In both cases, if the examiner asks after the reporting date, but before the issue to the public, after the issue to the public, but before the AGM, or even after the AGM, auditors do not have any obligation on them, because it is the management. It is the management who have the primary responsibility. Primary responsibility to prepare financial statements. To prepare financial statements. But when this is brought to the auditor's attention, he needs to respond in the most appropriate manner. Including seeking legal and technical advice. Asinyamaze tu, akielezwa, unajua ashamaliza, asharipoti. So if it's brought to his attention, that's when he reacts in the most appropriate manner. Kama vitabu zishapeanwa kwa general public, aangalie kwamba general public has been advised that there's another set of accounts. Ni kama vile tunaona serikali ikirecall unga saa zingine ikuwa na aflatoxin. Nasikia unga yote iko kwa shelves itolewe, iko na high levels of aflatoxin. The same thing. The books of accounts which have already been published, tuwa tunaona kwa bank wameziweka kwa a notice board pale, may be recalled if what has happened is so major that it renders those financial statements null and void. So as an auditor, you have to follow up to make sure that that was done. So after reporting, and before issuing to the public, this is what you say. After being issued to the public, this is what we say. Auditors do not have any responsibility. But here, the auditor has got some responsibilities. This is where we perform audit procedures. So, story hapa, we call them audit procedures, which includes Roman number 1. We need to check on the criteria. Let me read those points for you, because those are very, very sensitive. Those are very, very, very sensitive. Those are very, very sensitive points, around 8 of them. Number 1, review the procedures. So we are discussing audit procedures after the balance sheet date, but before the reporting date. Audit procedures after the balance sheet date, but before reporting date. Review the procedures adopted by management. Review the procedures adopted by management. Review the procedures adopted by management for identifying any post-balance sheet events. Review procedures adopted by management for identifying any post-balance sheet events, considering the effectiveness of these procedures. Considering the effectiveness of these procedures. Yeah, you have seen we've really argued out whether an event is adjusting or non-adjusting and such. So we want to see the criteria, the procedures used by management for classifying such events. Number two, read minutes of directors. Read minutes of directors. Read minutes of directors and management. Read minutes of directors and management. Read minutes of directors and management, including AGM minutes. Including AGM minutes, that's annual general meeting. Sorry, read or review minutes of directors and management, including AGM minutes. Concerning material subsequent events, including AGM minutes, concerning material subsequent events, concerning material subsequent events, and how they will resolve them, 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 and how they will resolve them. All right. Number three, verify events identified. Verify events identified by management. Verify events identified by management. And ensure that verify events identified by management and ensure that they have been given appropriate accounting treatment. Ensure that they have been given appropriate accounting treatment. Ensure that they have been given appropriate accounting treatment. They have been given appropriate accounting treatment. Hapo tunasema that adjusting events were adjusted, non-adjusting were not adjusted. And those which are perversive, they have been recorded in the notes to the financial statements. Number four, review the budget. Review the budget. Review the budget, comma, profit forecast, profit forecast, profit forecast, and cash flow projections. Review the budget, comma, profit forecast, and cash flow projections in order to be able to address, in order to be able to address, in order to be able to address the company's trading position, in order to be able to address the company's trading position and going concern, in order to be able to address the company's trading position and going concern, in order to be able to address the company's trading position and going concern. Last sitting, is it last sitting or but one intermediate? Tulikuwa tumeulizwa the relationship between subsequent events and going concern. 4 marks. Yeah, they have some relationship. There are some subsequent events that arise and affect our going concern negatively. You can imagine losing a court case, and it related to a building where if you lose, the building will be demolished. It affects your going concern. So it's a subsequent event with going concern complications, with going concern complications. Next, inquire from lawyers. Inquire from lawyers. Inquire from lawyers regarding status of cases. Inquire from lawyers regarding status of cases, regarding status of cases, and extent of liability regarding status of cases and extent of liability and extent of liability, so that we're able to make the provisions we saw that court cases, litigations are adjusting events. Lawyers can shed more light so that we are able to have reasonable estimates. Next. Check the account receivables. Check the account receivables and cash received from debtors. Check the accounts receivables and cash received from debtors and cash received from debtors to determine whether the accounts receivable balances, to determine whether the accounts receivable balances have been realized. The accounts receivable balances have been realized. The accounts receivable balances have been realized. Next. Obtain management representation letter. Obtain management representation letter. Obtain management representation letter. Obtain management representation letter is a confirmation that management have discussed the subsequent events. Management have discussed the subsequent events that could have occurred. Management have discussed the subsequent events that could have occurred. Management have discussed the subsequent events that could have occurred. That's a very important point. I always remind my students that that's a point that should never miss in any audit procedures. So later along, when discussing audit procedures on going concern, the last point will be seek management representation letter. Audit procedures on group accounts, seek management representation letter. Audit procedures on contingents, seek management representation letter. Audit procedures on ISA 550, related party, seek management representation letter. Even if you are auditing an asset, a motor vehicle, you remember when you're discussing assertions, there are instances have indicated ISA 580. Yes, that's it. But even when you're auditing motor vehicles, auditing buildings, always as a last audit procedure, seek management representation letter on presentation and disclosure. On presentation and disclosure. It reduces the element of auditor's liability because the courts can always say, you did all you could to gather evidence. And lastly, you required management to write a letter to you confirming some assertions. So it's a way of avoiding being negligent and reducing auditors' liability and reducing auditors' audit procedures. Mr. Ahmed said they must not be in that order, but representation letter has to be the last. You can start with either, but representation letter, it has to be the last because it's the last resort. You perform all the standard audit procedures only to seek representation letter as the last thing. A good question. All right. So for today, we stop at that. We proceed Juma Rijaro. All right, we say the grace. Now may the grace of our Lord Jesus Christ and the love of God and the fellowship of the Holy Spirit be with us now and forevermore. Amen. So blessed evening, be safe. Kesho mtu akimbie kanisani. Tuonane Juma Rijaro.